Hello and welcome to Indianomics. This is a very special edition of Indianomics because I don't have one panelist or two panelists or three panelists as I normally have, but I have a classroom full of panelists. The bright young minds of IIM Bangalore are with me to discuss some key issues in Indian banking. Our key panelist, of course, is Dr. Charan Singh, who is Professor of Economics at IIM Bangalore. My other panelist is the person who knows banking best, the Managing Director of State Bank of Mysore, Mr. Sharad Sharma. Gentlemen, thank you very much for joining me, and ladies and gentlemen, thank you very much. Well, first up, the big issue that bedevils the Indian banking system today is the issue of bad loans. We have numbers which say that the overall banking system has a gross NPL of 4.5%, but within that, the public sector banks have a higher percentage of almost 5.25%. And if you took the restructured assets, then for the overall system, the bad loans go to 10.9%, and for the public sector banks itself, it goes to 13.5%. So the problem is acute for the banking system. It is very acute for the public sector banking system. Let me start with you, Dr. Singh, as hopefully the neutral party. Is your sense that growth will ameliorate the problem? Often when the amount of good loans increase, the percentage of bad loans decreases on its own. That was our experience in 2003. Will we be able to repeat that?
Yes, thanks for inviting me on the panel, first of all. This is a very pertinent issue. 13% is really a very high non-performing assets. But I don't think there is a cause of worry, because if you look at the history of Indian banking, way back in 93, we were around 19%. But once the growth started picking up, our NPLs, non-performing assets, started coming down drastically. For a very long time, we were hovering around 2%. So my own feeling is, firstly, we should not be startled and get worried about it. We have done it in the past, we can do it again. The only thing that we need to focus on is growth. And that's what is...
But how much time do you think, sir? You know, the Reserve Bank's financial stress document, a stress assessment said that it will rise up to September and probably fall by March, the gross NPL percentage. Are you confident that within a year, that is what, 10 months from now, we should be able to see smaller ratios at least?
My gut feeling is that it is related to growth. Stalled projects were the major factor which led to such high NPAs because of the previous regime. All those bottlenecks have been cleared. One can clearly see the government is moving ahead. That's also changing the sentiments in the country. Once it starts translating into growth, I'm not very worried it will happen in next 6 months or 9 months, but I see the positive trend, and I'm sure within the next 2 to 3 years, we'll see a total change in the NPA system.
Okay, 2 years is a little more than what the Reserve Bank has at least guided, or rather the FSDC has guided. Your gut, Mr. Sharma, you think a year is enough to bring the ratio down?
Thank you, Latha, first of all, for inviting me for this program. I would take that with a pinch of salt because, see, the NPL ratios coming down, I think that would be a derivative of the credit multiplier. Actually, the issue is why we are in this current phase is that, of course, the government is concerned about the fiscal deficit part of it. So that spending, that pump priming sort of thing is not happening. Equity is not there in the market. And most of the sectors have been affected by demand. If you look at the major sectors, there is a problem with iron, steel. I mean, there is dumping which is there, and infrastructure and mining. So I would say maybe things may change, the sentiment may change in the current year. But as far as growth of credit is concerned, maybe it will get on to next year, when the NPL levels will come down to what...
So, scratch that point further, Mr. Sharma. We don't have one NPL number. We now have NPL number, we have a restructured assets, and we have a refinanced 525. This total will look larger by March, you think? Because 525 is a new baby.
Yes, the CDR, there are hardly any proposals which are coming for CDR. All that has got sweated out, but yes, the project loans, that 525, that is going to expand. I mean, you have seen in this quarter itself the steel companies, huge debts, 30,000 crores, 40,000 crores. So they're all being refinanced. So yes, maybe in this calendar year there will be a little more of 525, and then things will.
Okay. Well, just to get a little more color on steel itself, steel prices, if anything, have fallen in the last 4 weeks by about $20. The landed price, if it was $360, it has now become $340 because of the problems in China and the impact on commodity prices. So a calculation by Credit Suisse indicates that even the interest outgo of a lot of companies is about $200 per ton, and the EBIT they make, I mean only the stressed companies, the EBIT they make is like $30–40.
I did read that study by the Credit Suisse, and I did see the options that they had listed out. One of the options is the public sector banks, especially Punjab National Bank and State Bank of India, have a big exposure into the steel industry. And then one of the suggestions was that we could probably stop funding this industry, and obviously some of them will die.
No, funding the weaker guys.
Funding the weaker guys, and there will be less of capacity, less of supply, and therefore the price will find its own level. I think this is a much more complicated issue. I like to break it into two. The first is, we all know, and Mr. Sharma also mentioned, that there's dumping going on. We know what China is doing and how much they are subsidizing steel, and that's the problem we are facing. One factor could be we could raise the import duty. That's one.
That is being considered by the government.
That's one. The other is letting the industry, some part of the industry die. Now, I think that is where I want to bring in a new factor. And I want to link it back with the rising public sector banks' non-performing assets. Why are the public sector banks' non-performing assets rising? I have been mulling over this issue for quite a bit of time now, and I would like to mention here the public sector banks vis-a-vis the private sector banks are a different creature. They were first nationalized in 55, 69, 1980, taken away from the private sector for a very specific purpose. The purpose, of course, partly was financial inclusion, partly was to support employment. Now, if we start telling the public sector banks to withdraw from the steel company, that's very much against the very salt for which public sector banks were created. I think when the public sector banks were created, they have served a very important purpose. I can't imagine in 2008 crisis, if the public sector banks had not played the role that they played, where would the country have been? They played a very solid role. So therefore, I think it's time for India to stand up and say the Basel norms were made basically for the private sector banks. Our public sector banks have served a very important social role right from inception. They probably need accommodation and different benchmark at least for a few years.
Well, actually that will take us to another discussion altogether. The point is, I am not able to believe that all the NPL problems of the public sector banks or the higher NPL problems of the public sector banks are only because of their social purpose. I am not taking away from the social purpose that they must have served, but your take on that, Mr. Sharma.
Latha, besides the social purpose, you look at the core sector financing. Where has been the private sector bank in core sector?
Infrastructure.
They started off with retail, and they are a little in treasury. But say road, how many roads, how many steel plants they are into. And the second part is you have to keep in mind that asset has been created. You look at a steel plant, which you are saying that let it die its course. We are talking of 50,000 crores, 60,000 crores of investment which has gone into that asset. Now, for the sake of WTO, you say you can't provide production. Is there other option saying that 50,000 crores of investment runs to the ground, and what happens to the public sector, private sector in the public sector bank?
Would you say that the public sector banks were coerced or forced into giving any of the infrastructure loans?
I wouldn't say as far as the public sector banks. So I mean,
it was their commercial decision that this project would succeed.
Exactly, it was. I would say that suasion was only in the respect of the priority sector financing. Okay. So say that's 40%. But
which applies to private and public sector.
Which applies to private and public sector. Also, the only thing is focus, where you were allowed to give focus for that. Whereas I have to do an SME financing or number financing, which the private sector is not. So that's not an issue, but I would say, I mean, we took it as an opportunity. The economy was also growing.
Fair enough.
So it is a process of adjustment which we are looking at.
Okay.
And becoming a little more, I mean, street smart.
Okay.
From the
Do you think the NPL issue can be resolved by growth and by the normal course of business, or do you think some surgery is needed? For instance, steel, does it resolve itself if you leave it alone?
I would say give it 3 years time and it will resolve itself.
But how much money, sir? Aren't we putting good money after bad?
No, see, I'll tell you.
That money is well spent.
Our bank has exposure to 2-3 of the companies which are currently under this thing. And 1.5 years back, there was no issue. There was the adequate EBITDA. The only problem has come up because of the dumping part of it. And besides China, you also have Russia. You look at the ruble. In the last 1 year, the ruble has come down by 50%. Yes. So that is creating a demand issue.
Now, I just wanted to throw it open to the audience.
The government not only has to look at how much it pays back, but it also has to look at factors like employment. The corporate sector, the amount of people employed in that sector, that sort of surgery that you are referring to, if you go for that sort of surgery, many people, the unemployment rate in the country goes up.
Okay.
And then it
all right, so that's a different answer you're giving, that we cannot have surgical solutions to loans. I'll put it this way. When the promoters were getting $1,000 per ton, they were not sharing their profits with us. Now when the promoters are not getting $1,000, they're getting $250. Why should the nation share their losses, sir? Why should they not be allowed to die? I mean, why are you also opposed to that argument?
No, we are not opposed to it. There has been a change. If you look at it, the SEBI has done a change. Yes. Because of which now we can take over. And see, in all this thing, we are basically not addressing one factor which is also a reason. The legal enforcement system. Yes. And there are no takers. I mean, the whole economy, there is not that there are 5 companies on the block and there are 10 suitors. Yeah. Because it's the other way around. So that's also a problem.
Yes, I agree. POSCO just wound up its business, offices in Bhubaneswar. Yes, sir.
I have this, I'm looking at it from 2 different angles. One is the surgery thing that you're saying. The public sector banks, right from their inception, are a different motive. Unlike the profit-making private sector banks, they have so much of a psychology of a social sector that surgery for them, and you've just seen the argument from State Bank of Mysore, saying then run them down seems so much impossible against the very ethos of a public sector bank. The other thing that I want to bring to the front is, what about the rating agencies? What about the concurrent auditors? Where are those advocates, and how about those chartered accountants who certified all this? While the bankers were out there in the street lending, they were seeking support from all the support system. Where did they go wrong, and why are they not being held accountable? Okay. I think this episode should be used to bring them in and say you are equally accountable. We are looking for the heads of the public sector banks. How about you all?
Any reaction to that?
I'll let that pass.
Okay. No, my point is, we will, the general ambience will have to, bring the chartered accountants and the rating agencies also into account. But at the moment, they are not taking depositors' money and they are not taking the taxpayers' money for capital. We are speaking about the banks because taxpayers' money is involved in capital and depositors' money is involved in loans. And therefore, the first line of correction will have to come with the banks. And I'm not getting into the public sector argument just yet. My point is more clinical. Before we get into that argument, I just wanted to ask whether you need extraordinary solutions. I just want your word on that, a single sentence. Do you think you need extraordinary solutions, or do you think you can just wait on endlessly? Maybe 3 years, 4 years?
I would say reform the legal system, and we'll take care of us.
Okay.
My reading is this is an opportunity. This should be used. We really need to do many things, but surgery is not that option. Reforms strategically done so that we don't rock the boat. We don't impact our international ratings.
Okay. Any reactions? Okay.
Ma'am, you had spoken about the steel industry and considering the gestation period for all these infrastructural companies, and also considering what Professor Charan was talking about, how systemically important public sector banks are. Don't you think there are certain maybe revisions required in the norms for classifying non-performing loans in the public sector banks alone, vis-a-vis the norms which we use for private sector banks? Because considering the long gestation,
the norms are the same for public and private sector banks in terms of classifying NPL.
Yes. So don't you think that it needs to be revised? That's my question.
My reading is we Indians are so much used to believing what the Basel norms or what international community says, we want to follow it lock, stock, barrel without thinking we are different. Public sector banks have performed a totally different rule since their inception. We should have the confidence and courage to say these are different animals. Basel norms will apply to them after a specific period of time.
We cannot have different norms for NPLs. NPLs have to be recognized. It is better that they are recognized and the legal system rises to the occasion to answer them, would be my position. But
to that extent, I would disagree with our colleague here and say that the norm should be the same, because then you know the problem and you start looking for a solution. Otherwise, that complacency stretches on and coherent, deterrent action will not follow.
Okay, we need to take a break, but we will come back and now perhaps switch the questions to how you can reform the public sector banking system. We are back in a minute.